Risk pooling and reinsurance insurance exam prep. Question 1. What concept describes combining individual risks to predict future losses accurately? Facultative reinsurance, excess of loss, risk pooling, quota share. Risk pooling groups similar exposures to predict losses more accurately using the law of large numbers. Question 2. In a reinsurance transaction, what is the insurer that transfers the risk called? Underwriting risk, ceding company, indemnification, risk pooling. The ceding company is the primary insurer that transfers its risk to a reinsurer. Question 3. What is the insurer that accepts the transferred risk called? Underwriting risk, assuming insurer, retention limit, quota share. The assuming insurer, reinsurer, accepts the risk from the ceding company. Question 4. Which type of reinsurance covers an entire class or portfolio of risks automatically? Risk pooling, treaty reinsurance, loss ratio, underwriting risk. Treaty reinsurance is an automatic agreement covering a specific class of business. Question 5. Which type of reinsurance is negotiated on a case-by-case, individual risk basis? Quota share, catastrophe cover, facultative reinsurance, treaty reinsurance. Facultative reinsurance requires individual negotiation and acceptance for each specific risk. Question 6. What is the process called when a reinsurer transfers its own risk to another reinsurer? Premium volume, assuming insurer, retrocession, loss ratio. Retrocession occurs when a reinsurer cedes portions of its risk to a second reinsurer. Question 7. What is the maximum amount of risk a primary insurer keeps for its own account? Retention limit, facultative reinsurance, retrocession, law of large numbers. The retention limit is the portion of risk the ceding company retains before reinsurance applies. Question 8. What is the fundamental goal of purchasing reinsurance for a primary company? Spread of risk, premium volume, retention limit, loss ratio. Reinsurance helps spread the risk, protecting the primary insurer from catastrophic losses. Question 9. Which reinsurance arrangement shares premiums and losses based on a fixed percentage? Reinsurance broker, underwriting risk, premium volume, quota share. Quota share reinsurance divides premiums and losses proportionately. Question 10. Which arrangement pays only when a loss exceeds a specific predetermined amount? Risk pooling, excess of loss, quota share, assuming insurer. Excess of loss reinsurance triggers only after losses exceed a specified threshold. Question 11. What type of reinsurance protects against massive simultaneous losses from events like hurricanes? Ceding company, assuming insurer, catastrophe cover, risk pooling. Catastrophe cover protects insurers from massive accumulated losses from a single event. Question 12. What benefit does reinsurance provide by freeing up capital for the ceding company? Surplus relief, assuming insurer, underwriting risk, quota share. Surplus relief allows the primary insurer to write more business without straining capital reserves. Question 13. What term describes an insurer's financial ability to write new policies? Loss ratio, spread of risk, capacity, facultative reinsurance. Capacity refers to the maximum volume of business an insurer can write safely. Question 14. Who acts as an intermediary to negotiate contracts between primary insurers and reinsurers? Treaty reinsurance, surplus relief, spread of risk, reinsurance broker. A reinsurance broker facilitates agreements between ceding companies and reinsurers. Question 15. What principle allows risk pooling to effectively predict expected losses? Excess of loss, law of large numbers, surplus relief, loss ratio. The law of large numbers makes aggregate losses more predictable as the group size increases. Question 16. What describes the transfer of financial consequence of a loss to an insurer? Treaty reinsurance, surplus relief, indemnification, ceding company. Indemnification restores the insured or ceding company to their pre-loss financial condition. Question 17. Who issues the policy directly to the consumer? Premium volume, primary insurer, reinsurance broker, spread of risk. The primary insurer writes the initial policy and is directly responsible to the insured. Question 18. What is the ratio of incurred losses to earned premiums? Capacity, retention limit, primary insurer, loss ratio. The loss ratio measures the percentage of premiums used to pay claims. Question 19. What is the risk that premiums will not cover actual claims and expenses? Ceding company, loss ratio, risk pooling, underwriting risk. Underwriting risk is the danger that underwritten risks will result in excessive claims. Question 20. What measures the total amount of premiums written by an insurer? Reinsurance broker, premium volume, underwriting risk, surplus relief. Premium volume indicates the total premiums collected over a period.